For the global economy, the 8th year into the new century was a tragic year. As a result of the subprime mortgage crisis, the domino effect gradually became apparent. Following the insolvency of Bear Stearns in April and its placement in trust in July, the crisis of the two houses, Freddie Mac and Fannie Mae, erupted in July, triggering a frenzy of. In early September, the U.S. government was forced to promise to take over the two houses. On the 15th of September, Lehman Brothers, the fourth largest investment bank in the U.S., declared bankruptcy, while Merrill Lynch was acquired by Bank of America. On the 15th of September, Lehman Brothers, the fourth largest investment bank in the U.S., declared bankruptcy, while Merrill Lynch was also bought by Bank of America. Finally, Morgan Stanley and Goldman Sachs, the only two remaining major U.S. investment banks, were forced to transform themselves into bank holding companies. At this point, the U.S. subprime mortgage crisis escalated into a global financial crisis. A financial crisis, also known as a financial meltdown, is a crisis in which all or most of the financial resources of a country, or a large number of countries and regions, are destroyed. A financial crisis is a crisis in which all or most financial indicators, such as short-term interest rates. Financial crisis, also known as a financial meltdown, is a sharp decline in all or most financial indicators, such as short-term interest rates, monetary assets, securities, real estate, land prices. A financial crisis is a sharp, short-lived and hypercyclical deterioration of all or most financial indicators, such as short-term interest rates, monetary assets, securities, real estate, land prices, business bankruptcies and financial institution failures, in a country or in many countries and regions. The hallmark is a sharp, short-lived and hypercyclical deterioration in currency values across the region, based on expectations of a more pessimistic economic future. The region as a whole experiences a large depreciation in currency values, a large loss of economic aggregates, and the economic growth is undermined by a large loss of economic volume and scale. This is often accompanied by massive business closures, increased unemployment, widespread social depression, and, in some cases, this is accompanied by social unrest or national political unrest. The financial crisis is a capitalist economic crisis. It can be argued that financial crises are an inherent part of capitalist economic crises. The world economic panic of the 1930s was preceded by a severe financial crisis. The Mexican financial crisis of 1994 and the Asian financial crisis of 1997 were preceded by severe financial crises. The Mexican financial crisis of 1994 and the Asian financial crisis of 1997 both occurred first in the capitalist world. It is clear that financial crises have institutional roots and are capitalist crises. The possibility of a financial crisis exists in a market economy. The possibility of financial crises exists because of the spontaneous monetary and credit mechanisms inherent in a market economy. Once financial activity gets out of control and the contradictions in money and capital lending intensify, financial crises manifest themselves. Once financial activity gets out of control and contradictions in money and capital lending intensify, the financial crisis manifests itself. The outbreak of the financial crisis in the United States. The outbreak of the financial crisis in the U.S. is a good example of this. On the face of it, the financial crisis in the U.S. was caused by problems in the derivatives of home mortgages. But in fact there is a deeper reason. There are two reasons for the U.S. financial crisis: the imbalance between the U.S. financial order and financial development, and the fundamental problems of the economy. 1. The imbalance between the financial order and financial development, and the fundamental problems of the economy. The imbalance between the financial order, financial development and financial innovation, and the lack of financial supervision were the causes of the U.S. financial crisis. The lack of financial supervision is an important reason for the financial crisis in the U.S. The imbalance between financial order and financial development. The United States has been in the midst of a financial crisis. In the United States, after the Great Crisis of 1933, the Glass-Steagall Act was introduced, imposing strict sectoral regulation and a lack of financial supervision. In the United States, after the crisis of 1933, the Glass-Steagall Act was introduced, imposing strict sectoral regulation and separation of business. Over the next 60 years, The U.S. financial sector has experienced unprecedented growth, but its rapid development has been accompanied by, in 1999, Congress passed the Financial Services Modernization Act. In 1999, the U.S. Congress passed the Financial Services Modernization Act, which introduced financial. In 1999, the U.S. Congress passed the Financial Services Modernization Act, which liberalized and deregulated the financial sector, and ended the separation of banking, securities and insurance. In 1999, the U.S. Congress passed the Financial Services Modernization Act, which introduced financial liberalization, deregulation and ended the separation of banking, securities and insurance. The result was a gradual loss of control of financial activities. In addition, problems in the financial ecology contributed to the further development of the financial crisis. The financial ecology is essentially a reflection of the organic value relationship between the internal and external elements of finance. The financial crisis in the U.S. was not just a matter of financial regulation. The financial crisis in the U.S. was not only a matter of financial regulation, but also of social credit deterioration, lack of regulation and market disruption, as demonstrated by the subprime crisis. The financial crisis in the U.S. is not only a problem of financial regulation, but the social credit evil, lack of regulation, market disruption, information asymmetry and moral hazard shown in the subprime crisis. The subprime mortgage crisis was a major manifestation of the problems in the financial ecology. Since 1999, financial deregulation in the United States has led to problems in the financial ecology. The financial ecosystem has been in trouble since 1999. Financial derivatives became fractured and the value chain, the chain of value, was lengthening, finally breaking at the weakest link of real estate mortgages, which led to the subprime mortgage. The subprime mortgage crisis was triggered by a break in the chain, Wall Street's response to the collateralized debt obligations, CDOs and MBSs. Gradually, higher equity ratios, investment banks became more leveraged and financial risks piled up. The financial risks were piled up and magnified indefinitely. The outbreak of the financial crisis was accelerated by problems with the fundamentals of the U.S. economy. Between the end of the 20th century and the beginning of the century, the world economic landscape underwent a major restructuring. The world's original supply and demand curve broke down and prices rose. The United States took unilateral control of aggregate demand. The U.S. adopted a unilateral approach to controlling aggregate demand, which led to a widening of the original supply gap and a rise in prices. The U.S. adopted a unilateral approach to controlling aggregate demand, which led to a widening of the original supply gap, a steady rise in prices, a reversal of the employment situation, and an increase in incomes and purchasing power. The U.S. has adopted a unilateral approach to controlling aggregate demand, which has led to a widening of the original supply gap, rising prices, a reversal in employment, and a decline in incomes and purchasing power. In addition, over the past 60 years, the U.S. economy has grown and domestic consumption. The U.S. economy has grown and consumed more than its productivity could sustain. On the one hand, the real economy has been virtualized and the virtual economy bubbled. On the one hand, the U.S. has been able to achieve unsustainable growth through the virtualization of the real economy and the bubbling of the virtual economy. On the other hand, the U.S. has been able to pay off its huge historical debt through the U.S. dollar's reserve currency status and capital markets. On the other hand, the U.S. spreads its huge historical debt to the world through the reserve currency status of the U.S. dollar and the value transmission mechanism of the capital markets. This has increased the dependence of the U.S. economy. This increased the dependence of the U.S. economy and the U.S. dollar and the confidence in them. A series of restrictive import and export laws and policies introduced by the U.S. government prior to the subprime crisis were the cause of the crisis. The economic environment was weakened as a direct result of a series of bills and policies introduced by the U.S. government prior to the subprime crisis that restricted imports and exports. Various trade barriers were imposed on developing countries on the import side and on the export side. These policies directly contributed to the rise in prices in the U.S. and reduced the number of U.S. exports. These policies directly contributed to the rise in prices, reduced employment opportunities in the U.S. and dampened domestic. These policies have directly driven up prices, reduced employment opportunities in the U.S., and dampened the incentive for economic innovation in the country, which was an important trigger for the outbreak of the financial crisis. This financial crisis will significantly weaken the U.S., one of the, reflected in its control over global capital markets. In the financial crisis, a large number of U.S. investment banks, hedge funds and private equity funds were a serious blow. These investment institutions collapsed first. No one dared to buy U.S. financial products anymore, immediately causing a credit crunch. Next, a large number of related businesses collapsed, which had a considerable impact on the strength of the U.S. economy. The impact on the economic strength of the U.S. would be considerable. Secondly, it is in the area of soft power. Over the past 20 years, the entire American economic system has been run on the core of finance. This system is considered to be the best model for economic development. It is even thought that the U.S. model has beaten cyclical fluctuations. The U.S. model was even thought to have overcome cyclical fluctuations. Now, this economic system is based on the laws of the market, of which the Americans are most proud, have collapsed in a boom-to-bust sequence, from financial to real, from boom to bust, from financial to real. This has done considerable damage to both the hard and soft power of the U.S., especially the U.S. financial model has been used as a model for reform, especially by many emerging market economies. Financial model as a model for reform. It is time to think seriously about the role of this. The role of this model should be seriously considered, and the power of the U.S. example should be greatly reduced. The financial crisis has not only hit the U.S. hard, but also the global economy. The financial crisis has not only hit the U.S. hard, but also the global economy. At a time of global financial integration, the U.S., as the world's trendsetter, has been a major player in the global economy. In today's global financial integration, the U.S., as the world's weather vane, has to sneeze and the whole world has to catch a cold, not to mention such a serious financial crisis. The United States is the world's leading financial center, and a sneeze can catch a cold, not to mention a financial crisis of this magnitude. In this regard, economist John Yuga says, the global financial turmoil has destroyed most of the achievements of the U.S. and European financial sectors over the past decade. The global financial turmoil is likely to drag the global economic cycle into a cold, lost decade. While destroying most of the achievements of the U.S. and European financial sectors, the global financial turmoil is likely to drag the global economic cycle into a cold, lost decade.